If you have more than $25,000 sitting in one bank account, do not move it yet. Not because your money is illegal. Not because the bank is about to take it. And not because $25,000 is some magic government limit. The real danger usually starts after someone gets scared. They hear that the bank watches large transactions. They hear that the IRS receives certain reports. They hear that retirees should never keep too much cash in one place. Then they panic and start moving money in strange little pieces. 5,000 here, 9,000 there. A little cash withdrawal today. Another one next week. A check to one account. A wire to another. No notes. No records. No clear reason written down anywhere. That is when a simple money move can start looking more suspicious than it really is. This video is not about hiding money. It is not about avoiding reports. It is not about tricking your bank, the IRS, or anyone else. This is about moving your own legal money cleanly, with the right records, into the right place, before a simple transfer turns into a stressful bank review. And if you are retired, close to retirement, widowed, helping a parent, selling a home, receiving an inheritance, or just holding more cash than you normally would, this matters more than most people realize. Because the money is not always the problem. The pattern is the problem. The missing explanation is the problem. And the panic move is the problem. So before you move $1, do these 4 things in order. Decide what money must stay liquid. Choose the right destination before you move anything. Build a records folder before the transfer. Then move the money cleanly, not cleverly. Let us start with the mistake that gets people into trouble. Most people do not make a bad money move because they are trying to do something wrong. They make a bad move because they are trying to avoid doing something wrong. They hear about the $10,000 reporting rule and think, if I keep everything under that number, I am safer. That is the dangerous misunderstanding. A report by itself does not mean you broke the law. Financial institutions have reporting duties for certain currency transactions. If you deposit or withdraw more than $10,000 in cash, the bank may have to file a currency transaction report. That report is not an accusation. It is a compliance report. But deliberately breaking up transactions to avoid a reporting requirement can create a much bigger problem. For example, imagine a retired couple sells an old car for cash and receives $14,000. The clean move is simple. Deposit the money, keep the bill of sale, keep a note that says where the money came from, and answer honestly if the bank asks. The messy move is different. They deposit $7,000 on Monday and $7,000 on Friday because they heard $10,000 is dangerous. Now the money itself may be completely legitimate, but the pattern looks like it was designed to avoid attention. That is exactly the type of behavior you do not want to create. The safer goal is not to avoid normal banking visibility. The safer goal is to make the source, purpose, and destination of your money easy to explain. That one sentence can save people a lot of stress. Make your money easy to explain. Now let us talk about why having too much cash in one bank account can be a real planning issue, even when there is nothing suspicious about it. There are 3 separate problems that get mixed together. Problem 1 is idle cash. If a large amount of money sits in a regular checking account or a low-interest savings account, it may feel safe because you can see it every day. But over time, low interest can quietly reduce your buying power. Groceries go up. Insurance premiums go up. Property taxes go up. Medical costs go up. Meanwhile, the money earns little or nothing. For retirees, this is not just an investment issue. It is a lifestyle issue. Cash is useful. But cash in the wrong place for too long can quietly lose strength. Problem 2 is protection. Bank deposits can be insured, but insurance has limits and categories. A single account at one insured bank is not the same as a joint account, an IRA deposit account, a trust account, or money at a different insured bank. Credit unions have their own federal share insurance system when they are federally insured. The key point is simple. Do not assume every dollar in one place has the same protection just because the bank name looks familiar. If your balance is large, you want to know how it is titled, what institution holds it, what ownership category it falls under, and whether it is inside the applicable insurance limits. Problem 3 is movement. Money can sit quietly for years. Then one day, something changes. You sell a house. You move closer to your children. You receive life insurance proceeds. You close an old account. You transfer money after a spouse passes away. You help a child with a down payment. You move money from a bank to a brokerage account. You open a Treasury Direct account. You shift money to CDs or Treasury bills. None of those things is automatically suspicious. But if the move is large, unusual for your account, broken into strange pieces, or unsupported by paperwork, it can create questions. That is why $25,000 is useful as a personal review number. Again, $25,000 is not a legal threshold in this video. It is not a government reporting line. It is not a rule that says you must move your money. It is a practical number that should make you pause and ask, do I know why this money is here? Do I know how much needs to stay liquid? Do I know whether the balance is properly protected? Do I know where the rest should go? And if someone asks me about this transfer later, can I explain it in 1 minute with documents? If the answer is no, now let us walk through the 4-step process. Step 1. Decide what money must stay liquid. Before you ask, where should I move this money? Ask a better question. What money should not be moved? Because some cash belongs close to home. Everyday spending money should stay easy to access. That means your monthly bills, grocery money, prescriptions, utilities, insurance drafts, rent or mortgage payments, and normal debit card or check activity. Emergency money should also stay accessible. If the water heater breaks, the car needs repairs, a medical bill comes in, or you need to travel for a family emergency, you do not want every dollar locked away. But there is a difference between accessible and idle. For some people, 1 or 2 months of spending and checking may be enough. For others, especially retirees with irregular medical costs or family obligations, they may want more. The right number depends on monthly expenses, income reliability, health needs, family support, and personal comfort. This is not about copying someone else's number. It is about separating money by job. Checking account money has a job. Pay bills. Emergency savings has a job. Handle surprises. Short-term reserve money has a job. Stay safe and available in the near future. Longer-term money has a different job. Preserve value, produce income, or support future needs. When all of that money sits in one account, every dollar looks the same. That is when people either leave too much idle or move too much at once. So write this down before making a transfer. I need this much for monthly spending. I need this much for emergency access. I need this much for upcoming expenses. The remaining amount can be moved only after I choose the right destination. That one page turns fear into a plan. Step 2. Choose the right destination before moving anything. This is where many retirees make a second mistake. They decide to move money before they decide where it belongs. That creates rushed decisions. They open a random account because it has a high advertised rate. They move money to a family member temporarily. They buy something they do not understand. They lock up money they may need soon. Or they chase a rate without checking insurance, fees, liquidity, or tax treatment. The destination matters. Here are common options people consider. A high-yield savings account may be useful for emergency money or short-term reserves because the money can often remain accessible while earning more than a basic checking account. But you still need to verify the institution, insurance coverage, account limits, transfer rules, and whether the rate can change. A certificate of deposit, or CD, may be useful for money you do not need immediately, but CDs can have early withdrawal penalties. If you might need the money next month, locking it up for a year may create a new problem. Treasury bills are short-term U.S. Treasury securities. They mature in terms such as a few weeks to 1 year. They are often used for conservative short-term cash planning, but they are not the same as a bank savings account. You need to understand how they are purchased, when they mature, how you get your money back, and what happens if you sell before maturity. A brokerage money market fund may be useful for some investors, but it is not the same as a bank deposit account. It may have different protections, different risks, and different rules. Do not assume FDIC insurance applies just because the account is connected to a familiar financial brand. A federally insured credit union account may be a good option for some people, especially if rates or service are better. But credit union accounts are covered by NCUA share insurance when federally insured, not FDIC insurance. You still need to verify coverage and account ownership. There is no single best answer for everyone. The right destination depends on the job of the money. Money needed next week should not be treated the same as money needed 2 years from now. Money used for bills should not be treated the same as money set aside for taxes. Money received from a home sale should not be treated the same as Social Security income. Money held for a trust or estate should not be treated the same as personal spending cash. So before you move anything, write the destination next to the purpose. For example, monthly bills, keep in checking. Emergency reserve, move to insured high-yield savings. Taxes due next April, keep in a safe short-term account. Longer reserve, discuss Treasury bills, CDs, or other conservative options with a qualified professional. Investment money, review with a fiduciary advisor before moving. That is how you avoid the trap of making a banking decision when you really needed a cash flow decision. Step 3. Build a records folder before the transfer. This may be the most important part of the entire video. Before you move a large amount of money, create a simple folder. It can be a paper folder, a folder on your computer, or both. Name it something boring and clear. 2026 Money Transfer Records. Inside that folder, put 4 things. First, a 1-sentence source note. Do not overcomplicate this. Just write where the money came from. This money came from the sale of my 2017 Toyota Camry on March 4th, 2026. This money came from the sale of my home at 123 Oak Street. This money came from life insurance proceeds after my spouse passed away. This money came from savings accumulated from pension and Social Security income. This money came from an inheritance distribution from my father's estate. Second, put the proof document in the folder. That could be a bill of sale, closing statement, inheritance letter, estate document, insurance payment letter, gift letter, tax document, bank statement, brokerage statement, pension statement, or transfer confirmation. You do not need a mountain of paperwork for every situation. You need enough to show the source and path of the money. Third, write the destination note. I moved this money from Bank A savings to Bank B high-yield savings. I moved this money from checking to Treasury Direct. I moved this money from a local bank account to a brokerage account for short-term Treasury bills. I moved this money from one account to another after reviewing deposit insurance limits. Fourth, save confirmation records. Keep the transfer confirmation, wire receipt, check image, account statement, or transaction history that shows the date and amount. This is not glamorous. It is not a secret loophole. It is not a trick. But it is powerful because it turns a vague memory into a clean paper trail. 6 months later, if your bank asks a question, you are not trying to remember what happened. 2 years later, if your tax preparer asks where money came from, you are not digging through old emails. If your adult child has to help you after a health issue, they are not guessing. If your spouse passes away, the surviving spouse is not trying to decode every transfer. The folder does not just protect you from questions. It protects your family from confusion. Step 4. Move money cleanly, not cleverly. Once you know what money must stay liquid, once you know where the remaining money should go, and once your records folder is ready, then you can move the money in a normal way. Use ordinary channels. ACH transfer. Wire transfer. Check. Account-to-account transfer. Whatever is appropriate for the institution and amount. But do not add complexity for no reason. If one clean transfer matches the real purpose, one clean transfer is usually easier to explain than a dozen strange ones. If the bank asks the purpose of the wire, give the real purpose. Moving personal savings to another account. Home sale proceeds. Estate distribution. Funding Treasury purchase. Transferring emergency reserve. Do not invent language. Do not joke. Do not say, I am trying to stay under the limit. Do not say, I do not want the IRS to know. Do not ask the teller how to avoid a report. You do not need to sound like a lawyer. You need to sound like a normal person doing a normal transaction with clean records. There are also moments when you should slow down and get professional help. If the money is from a business sale, inheritance dispute, foreign account, large cash transaction, trust, estate, divorce settlement, tax debt, Medicaid planning issue, or anything involving another person's money, talk to a qualified tax, legal, or financial professional before you move it. If a government agency contacts you, do not handle it by guessing from online videos. Get professional advice. If the bank freezes or delays something, stay calm, gather records, and ask what documentation they need. Do not start moving money through other people in response. Remember the principle. Clean beats clever. Now let us apply this to a few common situations. Scenario 1. You sold a car for cash. You received $12,000. You are worried because you heard about the $10,000 rule. The wrong move is to split the cash into smaller deposits just to avoid a report. The cleaner move is to keep the bill of sale, deposit the money normally, and write a source note in your records folder. The report, if required, is not the issue. Trying to avoid the report can become the issue. Scenario 2. You sold a home and now have a large amount in one bank account. This is common for retirees. The wrong move is to start scattering money everywhere because you are scared. The cleaner move is to save the closing statement, decide what must stay liquid, check deposit insurance coverage, set aside taxes or upcoming expenses, and move the rest according to a written plan. A home sale is explainable. Make it easy to explain. Scenario 3. Your spouse passed away and money moved into your name. This is already stressful. Do not rush because a video scared you. Collect the death certificate, beneficiary paperwork, account statements, insurance letters, and estate documents. Then review which accounts need to be retitled, which bills must keep getting paid, and which funds should be moved later. This is a situation where a professional can be worth it, especially if trusts, estate accounts, taxes, or beneficiaries are involved. Scenario 4. You want to help a child or grandchild. Maybe you want to give money for a down payment, medical bill, school cost, or emergency. Do not move money casually through multiple accounts without records. Write down the purpose. Keep the transfer confirmation. Ask a tax professional whether gift tax reporting applies. The fact that you love your family does not remove the need for records. Scenario 5. You have been keeping $80,000 in checking because it feels safe. This is not a crime. It is just something to review. You might decide to keep a smaller amount in checking for bills, move emergency money to an insured savings account, place some short-term reserves into CDs or treasury bills, and review anything longer-term with an advisor. The point is not to move everything. The point is to give every dollar a job. Now, before we close, there are a few myths we need to clear up. Myth 1. If a bank report is filed, I am in trouble. Not necessarily. Certain reports are part of normal compliance. A report is not the same as an accusation. Myth 2. If I stay under $10,000, I am safe. That is not how you should think. Breaking up transactions to avoid reporting requirements can create a serious problem. The safer mindset is documentation, not avoidance. Myth 3. FDIC insurance means every dollar in my bank is covered. Not automatically. Coverage depends on depositor, institution, and ownership category. If your balances are large, check the details. Myth 4. Credit unions are not protected. Federally insured credit unions are backed by NCUA share insurance, but you still need to verify that the credit union is federally insured and understand the limits. Myth 5. Brokerage cash is the same as bank cash. Not always. Brokerage accounts, money market funds, treasury securities, and bank deposits can have different protections and risks. Do not mix them together in your mind. Myth 6. $25,000 is a legal trigger. That is not what this video is saying. In this video, $25,000 is a personal planning trigger. It is the amount where many people should stop and ask whether their money is organized, protected, and documented. So here is the 4-part checklist. Before you move a dollar, ask. Number 1. What money must stay liquid? Write down how much you need for normal bills, emergencies, upcoming taxes, medical costs, insurance, travel, and family obligations. Number 2. Where should the rest go? Do not move money first and choose later. Match the destination to the purpose. Checking, savings, CD, treasury bill, credit union account, brokerage account, or professional review. Number 3. What proves where this money came from? Create the records folder before the transfer. Add a source note, proof document, destination note, and transfer confirmation. Number 4. Is the movement clean and explainable? Avoid strange repeated amounts. Avoid unnecessary cash. Avoid moving money through other people. Avoid anything designed to hide the transaction. Use normal channels and keep normal records. That is the whole framework. Keep what must stay liquid. Move what has a better job somewhere else. Document the source. Document the destination. Move it cleanly. And if you remember only one line from this video, remember this. The goal is not to make your money invisible. The goal is to make your money easy to explain. Before you move a dollar, write down 3 things. Where did this money come from? Where's it going? What document proves it? If you cannot answer those 3 questions, pause. Get the record first. Then make the move. And if you know someone who has sold a home, received an inheritance, lost a spouse, retired recently, or has a large balance sitting in one bank account, share this with them before they make a panic transfer. Because one clean plan today can prevent a lot of confusion later.